Over 4 years, the American Civil War cost the Union and the Confederacy a combined $6.5 billion to fight. Wall Street erased more than double that amount of paper wealth in a single Tuesday afternoon. Following the First World War and a brief post-war recession, the United States entered a decade of continuous expansion. Automobiles transitioned from a rare luxury to a standard fixture in driveways across the country. Telephones and electricity reached homes and farms that had spent generations without them, and the radio became a mass medium almost overnight. For anyone living in an American city in the 1920s, the future seemed to be arriving in real time. This chart tracks the Dow Jones Industrial Average, the benchmark for America's largest companies, throughout the decade. In August of 1921, the index sat at 63 points. By September of 1929, it had climbed to 381, a six-fold increase in just 8 years. An index scaling that fast does not reflect a naturally expanding economy. It reflects a shared belief by millions of people that the climb will never stop. The country's most prominent economist, Irving Fisher of Yale, surveyed this growth and told the public that stock prices had reached a permanently high plateau. That belief was powered by a specific mechanism. Before the 1920s, owning $100 of stock generally required $100 in cash. Brokers bypassed this by introducing a system called buying on margin. This diagram illustrates how the math worked. A broker would let you put down as little as 10% of a stock's price in cash and lend you the rest. You put up $10, borrow $90, and control $100 of stock. If the stock price goes up, the arithmetic works beautifully. A modest rise in the stock's overall value translates into a massive percentage gain on your original $10 investment because you control 10 times your actual capital. It functioned like free money. But leverage cuts in both directions. If the stock drops, a small decline in price wipes out your entire $10 investment instantly, yet you still owe the $90 you borrowed. When that drop happens, the broker demands the difference immediately, in cash. This is called a margin call. While this arithmetic democratized the market for everyday people, it built a vast, unregulated volume of debt that relied entirely on the market's continued climb. By the late summer of 1929, factories had built capacity to meet what they assumed would be endless demand. Farms had expanded output for the same reason. When consumers could no longer keep pace, companies were left holding inventory they had to sell at a loss. The Federal Reserve grew alarmed. In August, they raised interest rates from 5% to 6% to make speculative borrowing more expensive. But margin lending was controlled by independent brokers, who kept the credit flowing as long as clients paid interest. In September, stock prices began a slow, grinding decline. As prices dipped, margin calls started going out. Investors had to sell their shares to cover their loans, which pushed prices down further, triggering more margin calls in a self-feeding cycle. On Thursday, October 24th, the cycle accelerated. The market opened and lost 11% of its value almost instantly. In the first 3 minutes of trading, nearly 3 million shares changed hands, erasing roughly $2 billion. The sheer volume of transactions overwhelmed the mechanical ticker tape system. It fell catastrophically behind, leaving brokers far from New York trading completely blind, watching numbers that reflected prices from an hour earlier. That afternoon, a group of powerful bankers pooled their money and sent a representative onto the trading floor. He visibly purchased large blocks of blue-chip stock at inflated prices, a calculated piece of theater designed to project stability into a panicking room. For one day, it steadied the market. But theatrical confidence cannot override a mathematical chain reaction indefinitely. Over the weekend, word of Thursday's panic spread across the country. Investors who hadn't sold decided they would exit their positions on Monday, refusing to wait around for a second rescue. On Monday, October 28th, the Dow fell 13% in a single session. The financial elites made no intervention. The safety net was gone. Then came October 29th, 1929, Black Tuesday. On the floor of the New York Stock Exchange, the selling was total. 16,410,000 shares changed hands in a single day of sheer chaos. The volume was so far beyond the machinery's capacity, that the ticker tape fell hours behind again, continuing to print transaction prices until nearly 8 o'clock that night. Nobody in the country knew what their investments were actually worth. The giants of American industry collapsed. Radio Corporation of America, the hottest stock of the decade, plummeted from a high of 505 down to 26. At certain points during the day, some stocks had no buyers at any price whatsoever. Desperate sellers could not find a single person willing to take their shares, even for pennies. Crowds stood paralyzed outside the exchange building, waiting for news as the reality of their ruin set in. By the time trading closed, $14 billion in market value had evaporated. Combined with the preceding days, $30 billion simply ceased to exist, revealing that the paper wealth of the 1920s had never truly been there at all. October 1929 was not the bottom. It was merely the beginning of a slide that would continue for nearly 3 more years. As stock values collapsed, margin investors defaulted on their worthless stocks. Banks, which had lent heavily against stock collateral or invested depositors' money directly into the market, suddenly found their assets gutted. Rumors of banking distress spread from neighbor to neighbor, prompting lines to form outside bank doors. Depositors made desperate rushes to withdraw their cash. No bank keeps enough physical cash on hand to pay out every depositor simultaneously. The fear of a bank failing is precisely what drains its reserves and forces it to close. Over the early 1930s, roughly 10,000 banks across the United States collapsed. Because federal deposit insurance did not yet exist, billions of dollars in personal savings evaporated permanently. What began as a punishment for Wall Street speculators mutated into a systemic contagion, tearing down the financial walls that protected everyday citizens. 90% of American households owned absolutely no stock, yet they absorbed the ultimate brunt of the collapse. With credit frozen and consumer demand completely vanished, factories slashed their production schedules and laid off workers by the millions. By the depths of the Great Depression, roughly 1 in 4 American workers was unemployed. Millions of people stood in breadlines in the middle of cities that had seemed unstoppable just 3 years prior. Displaced families built makeshift shantytowns out of scrap materials, bitterly naming them Hoovervilles after the president they blamed for failing to stop the ruin. On July 8, 1932, the Dow Jones finally hit absolute bottom, marking an 89th. Financial leverage creates a liability that extends far beyond the individual speculator. When the mechanism breaks, it possesses the power to drag an entire civilization down with it.